Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I will be your host. So today we're talking with Stanley Teitelbaum. Hey, Stan, how's it going?
I'm doing fine, Kirk. Thank you. And
Good.
thank you for reaching out to me for an interview, which might be a little out of the mainstream of the interviews you usually do.
Yeah, no, I really appreciate you having on the show. And before we kind of dive right in, I think Stan's topic is very apt for for what's going on in the world, and we really wanted to dive in. But before I get into that, Stan, tell us a little bit about your background.
Yes, I'm a clinical psychologist. I got my PhD a number of years ago, and over the years, many of my clients came to me because of their errors in judgment or poor decisions that were affecting their personal relationships. And in addition to that, it also seemed to happen with many clients who were concerned about their stock market investments and why they weren't doing better in that realm of their lives, and what were the factors that were penalizing them from being more successful. The other factor, which was also very meaningful for me in bringing me to this junction, was examining my own history in stock market investing, which included a lot of underperformance and errors of judgment and blind spots.
Yeah, well, we'll get into that a lot. I think you just dumped a lot of knowledge on us. So there's a lot of things when you get into psychology. Investing is primarily psychology, right? It's yes, you have to do the hard work, but there's so much of it that's psychology. What in your experience, like, what are some of the psychological issues that come up when it most commonly affect investors?
Well, there are so many emotional issues at play, like greed and fear and despair and regret and confidence and overconfidence and euphoria and sometimes, most of all, even the emotion of shame, all of which enter into the choices and decisions that people make about their buy and sell decisions.
Well, you mentioned a few of them. We talk about greed and fear in the show a lot. Those are two powerful emotions that basically move the markets, just those alone. But let's talk about some of the other ones. I mean, despair, regret, euphoria, shame. How do you see those coming into investing?
Well, despair is what a lot of people are feeling right now in the throes of this terrifying bear market that we're in. I think it's very meaningful and very important for investors to have a grasp of the history of the cycles within the stock market. Every bull market ends ugly. By definition, every bull market ends ugly. But what's important is for people to have an understanding or to grasp that there is a cycle of emotions, like leading from a bear market to a bull market, which includes phases like, first, despair, and then second would be relief, and then hope, and then optimism, and then exuberance, and then finally euphoria. That's the cycle going from bear to bull. Right now, we're very strongly entrenched in the first stage of that cycle, which is despair.
But, I have to ask, because it seems really bad. People feel really bad right now because the markets are down between 20 and 30% for both stocks and bonds, which is painful. Yet if you look back, we're still above the pre-COVID peak, well and above, like 10% above. So, you really just had, 2 years really just kind of disappear. It hasn't really been bad yet, but people feel it's bad. So are we really in the despair category, or are we just kind of starting down that slide?
I think people that talk to me are heavily into despair, and people tend to forget more than they remember what it was like prior to COVID. We've had a bull run of about 10 or 11 years, and people kind of kind of got used to the idea that, well, this was going to continue, that this was an extremely long bull run. And people kind of got used to the idea, well, this is good, and it just keeps going, and it just keeps going. And they weren't prepared. They weren't prepared for the abrupt turn in the bull toward the bear that happened earlier in this year. So I think many people are not appreciating the point that you made, which is that overall we may still be ahead of where we were at the beginning of the pandemic, but they're feeling the pain, and they're feeling the pain of the losses that they've experienced from the peak of their portfolio. And most bear markets average something like 35% of a decline from the peak, to the low, to the bottom. And we're now, as you pointed out, somewhere over 20%, which defines, of course, which is the definition of a bear market. And people are sweating about that part. And they're not thinking about, yes, I'm still ahead of where I used to be. They're thinking about how much they've lost. And loss is very painful. And enduring pain is part of investing in the stock market. That comes with the territory. And a lot of famous people have also cited that losing is as much as 2.5 times as painful as the joy of winning. We've heard about this also, like in the world of sports, people like Jerry West in basketball, and even more recently, Tom Brady in football, have said the same thing, that losing has been much more painful than the joy that they experience from winning.
Yeah, no, I know there have been a lot of experiments done to prove that point. So I can appreciate that perspective. But how can people get prepared, right? Because we've experienced 20, 30% downside in many indices, stocks and bonds. And, we might experience a lot more, right? This may be just the beginning of a really bad bear market. We talk about that on the show and on how, we think things are going to play out. So how can people prepare themselves? Because you'd think it's easy, but it's really difficult. So what would you suggest people do to prepare themselves?
Well, it's a little late in the game to prepare yourself by, I'm a big believer in cutting your losses, but it's a little late in the game at this point to be cutting your losses. So I think what is often helpful is for people to realize that there is a history, and the history tells us that bear markets always recover. There's never been a rolling period of 20 years ever where there has been a loss in the stock market as measured by the Dow Jones Industrial Average. So one way of preparing yourself or softening or cushioning the blow of the pain is to recognize some of these facets about history. Now, it's all about probability. There are no guarantees. We have no way of knowing where the bottom is going to be. The average is 35%. It could be less, like now. Most people say, well, it has to test the lows before it really can have a comeback. Traditionally, it's taken 567 days from the bottom for people to begin to really see more of an upside, and that it could be 1.5 years before they get back to where they were before the beginning of the bear market.
But psychologically, I mean, like because I think that's what you're saying is absolutely true, and I think we could argue. You said it's too late to cut losses. I always say it's never too late to cut losses, unless you're more than 50%, then it might be too late. But things could always get worse, right? I'm always reminded by a friend of mine who's in the precious metals mining space, and he has this joke. He's like, "What's a stock that's down 90%? It's a stock that was down 80% and then subsequently got cut down by 50% more, right? Like you can always lose more." So I think the question I would ask is like, mentally, how can people prepare? What should they be doing, thinking about, not necessarily from a portfolio perspective, but just kind of like mental health perspective?
Yes, I think they need to be able to have what we call a certain amount of emotional discipline. Discipline means not allowing yourself or resist getting swept up in the mania of a bull market and in the terror and panic in a bear market. In other words, being able to tell yourself that as bad as I may be feeling right now, and I may even start to feel worse as the market continues to decline, which will it might, but that this will change and that there is a cycle and I need not to, when we're in the throes of this decline, people are increasingly at risk to make more impulsive decisions and more errors in judgment. And so the way to cushion that is to remind yourself of what I said a moment ago, which is don't get swept up in the mania of the bull market and don't get swept up in the terror of the bear market.
Yeah, I mean that's easier said than done, though, right? I mean that's like saying, hey, don't buy in at the peak and don't sell at the bottom, but people do that. So how should people be thinking about it? How can they identify their own cognitive biases when they're looking at their own investments?
To whatever extent it helps, sometimes people say, well, I'm not in this alone. I'm not the only one experiencing this pain, this terror, this panic. This is what's happening right now. But the thrust of my argument has to do with people are attributing the decline to all of the factors that we're very familiar with, like inflation and higher gas prices and supply chain problems and problems with the economy and the war in Ukraine. And those are all external factors. But people are more reluctant to pay attention to the component of their own psyche, of their own emotional issues, which are contributing to how much they're losing. So to the extent that they could take a look at that and also be prepared in the future to be aware of what the common roadblocks are, they will do better going forward. Maybe not now, maybe not immediately, but that's a good way to cushion themselves for the future.
Okay. One thing you brought up earlier is the concept of blind spots. Can you talk about blind spots and how that affects investors?
Yes, I think what I outlined are what I see as the four most common blind spots or roadblocks that interfere with stock market success are buying high and selling low. People kind of follow the market, and if something is rising and continues to rise, then they want to jump in and then they buy high. And very often that backfires because it doesn't necessarily continue to show gains. And conversely, selling low is, people get fed up, people get tired, people get scared. And so they say, I got to bail out of this, I got to bail out of this. And so they sell. And very often the point at which they decide to sell is a point at or close to the low in whatever that stock might be. I'm going to backtrack for a second to your earlier question, because one research study that has been so important to me more than anything else is a study that shows that the stock market is often thought of correctly as the best place for people to invest their money. Why is that? Because as I said before, there's never been a losing 20-year period in the stock market. And since records were kept back in 1926, which is almost 100 years, there's been an average gain in the stock market as measured by the Dow Jones Industrial Average of 9.6% annually, almost 10% gain. Now that's pretty good. That's something that really is hard to beat. And that's a good reason why it makes a lot of sense to invest in the stock market. But the issue, the problem, and as has been pointed out in research studies, is that while the overall market is up 9.6% on average, for the average investor has gained something like 3.2% annually in those almost 100 years. So that's a whopping almost 7-point difference between the market performance and the underperformance of the average investor. So what are the factors that lead to that underperformance is what fascinates me more than anything. And so the first one is the buy high, sell low phenomenon. The second one is blind spot, following the herd, kind of, doing what everybody else is. Everybody else is buying this or selling that. I'm going to hop onto that bandwagon and do the same thing. This is what we call FOMO, right? Fear of missing out. If everyone else is doing this, it's got to be a great thing. I don't want to leave the party. I want to join the party. I want to get in on the party. So that propels a lot of people to jump in or to bail out at times, which tend to backfire, at times that also become late in the game, either on the buy side or on the sell side. And the third factor that I like to address is investors who may stay too long with underperforming financial advisors. People get very connected to their financial advisors. And if the performance fades or doesn't work out too well, very often investors will find all kinds of reasons to stay with those underperforming financial advisors rather than making some other choice or decision. And that leads me to the fourth factor, which is the looking for the guru syndrome. And looking for the guru syndrome means people want to feel like they're winners, but they don't necessarily feel they're equipped enough to know enough to be able to consistently pick their winners. So they want to find a hero. Psychologically, they want to find an authority that they can turn to who will protect them financially and lead them into the land of riches. And so they find a hero or a guru who they then anoint on their guru pedestal. And they look up to that person and they try to follow the advice of that person. And very frequently, what happens is that many gurus also then have clay feet. And it can be very difficult for investors to be able to deal with that, to recognize that, and to move on from that. I can tell you an example in my own personal odyssey. And so over a couple of decades, several decades, I worked with a number of financial advisors, and I probably picked not such good ones. And I'm sure there were a lot of good ones out there, like you, Kirk, and I picked people that all of whom, for one reason or another, disappointed me. But the one that I wanted to highlight is this person, this FA was recommended to me, and it was touted that you're gonna really like him. He doesn't like to lose money. He's very personable, and he's very available, and he's very smart. So I contacted this guy. He takes me out to lunch. We have a nice exchange, a nice discussion, and I open an account with him, a personal account and a business account, and we go on that way. And there's some winners, some losers. Nothing spectacular is happening in either direction. So at some point, he is fond of contacting me when he wants to recommend something. And he had a way of saying, Stan, I think you should take a look at or consider buying stock XYZ. I said, okay, tell me a little more about it. He says, well, you know what? The boys downtown are recommending this. And I'm thinking, the boys downtown, what is this? What do you mean by the boys downtown? Well, he was in a branch office of a very well-known brokerage house. And the boys downtown were the research analysts who were further downtown from Midtown from where he was. But to me, that had an aura of, oh, the boys downtown. This made it feel even more special. So frequently I would go with his recommendation because it came not only from him, but from, quote, the boys downtown. So anyway, at one point down the road, I said to him, I'm looking at my portfolio. It hasn't really done very much lately. How come I'm not more successful than I am? And he said to me, he said, you know what, Stan, I have to be honest with you. The truth is that we don't really know that much more than the average investor. And that really shook me up. That really knocked me to a loop. I said, what do you mean? He said, well, I'm telling you, we really don't know that much more than the average investor. Well, my reaction was, I didn't believe him. I didn't believe him. How could that be true? He was my guru. I needed him on that pedestal. We don't know much more. I said that internally, I was shaken up. I said, this can't be, I don't believe him. But then I realized the second level of what I was feeling was, I don't believe him because I don't want to believe him. I need to not believe him because it was more important for me to keep him up there on that pedestal. I was not ready or able to relinquish having my guru on my guru pedestal. And it took me some time before I was able to fully digest that and to be able to move on to other financial advisors for all kinds of other reasons also disappointed me in one way or another.
Yeah, no, I appreciate you sharing that, Stan. I think it's, the industry is very challenging for many ways. And, I think whether it comes from incompetence or negligence, or in some cases, just activity that's not allowed. Let's try to paint it nicely. But I think what you're referring to sounds to me like at the beginning of my career, the industry, when I worked at one of the big wirehouses, that was the industry. It was about selling stocks to people. And it was about coming up with an idea and selling stocks. I mean, I could tell you stories that they told me. I never really got comfortable with any of it. Some of the stories I heard were, you see this commercial of, hey, let's put lipstick on the pig and get out there and sell it. That wasn't too far from the truth. I don't know if you remember that. I think it was E-Trade or one of those companies, their commercials they didn't last long because I think they got knocked for that. But it wasn't too far from true, right? A lot of these companies were just like, hey, find something and sell it. It wasn't about advice. It was about, I think the phrase I always liked was, where in the world can you have millionaires show up in their Rolls Royce to get advice from people showing up in the subway? Like that was one of my favorite quotes about Wall Street. And, there's a lot of truth behind it, right? I mean, there are smart people out there. There are, dedicated people. And I think the industry's changed a lot, but there's still that element of what you were talking about, which is, selling ideas as opposed to, managing wealth, which is a totally different way to look at it. So I don't know if is that kind of what you saw?
Well, what more investors are becoming savvy about is that the recommendations that they're getting, they're paying a price for that. In other words, the people are realizing that the expense ratios of the funds that they may be being guided into, or the cost of working with an advisor, may sound negligible. Frequently, if you're working with an advisor, it could be like 1%. But if you're working with anyone, if you're paying some kind of management fee, it could feel negligible, but it's really not. I remember one of the many people that I was saying that also disappointed me was someone that I connected with because he had been regular on CNBC, and he was very, very good at what he was talking about. And I contacted him and I said, I want to open an account with you. And he took me on and he said, yes, and my fee would be 2% of assets under management. And I said to myself, and I said to him, great, you're terrific. I think you're terrific. You're going to do a great job for me. 2% is something I would happily be able to afford, because I'm anticipating that you're going to be able to garner much more than that for me. And that didn't happen. And I learned over time that the 2% or the 1% or the 0.75%, it adds up incrementally year after year after year. And that adds up to a lot that also serves to cripple one's portfolio. So I think what advisors have learned, which is also very helpful, and a lot of people need to also continue with their advisors, is that they have found ways to create or to provide value-added services. So it's not just about advising on what stocks or bonds to buy or to sell. And by the way, sell orders rarely happen. Suggestions really happen, much more about buying, but that they underperform, just like the mutual funds often underperform their benchmarks. As many as 75% of mutual funds underperform their benchmarks. So what works for advisors more recently, rather in contrast to the earlier days that you were describing, is if they can not just sell their stocks or recommendations, but also to demonstrate to their clients that they're interested in other aspects of needs that the client may have, other kinds of personal services, things like financial planning or retirement issues or college planning or things like that, that also could be part of what the client is paying for.
Yeah, I mean, I think if I'm hearing you, it just, in my experience, what it sounds like to me is it sounds like, and correct me if I'm wrong, but choosing a financial advisor is really no different than choosing a doctor or an attorney or an accountant, right? You're making a prediction about what the outcome is going to be, but you can't necessarily know what that outcome is going to be. You don't, like, I probably know 50 attorneys. Every friend, family member I know is an attorney. I'm surrounded by them. But yet, if I had to go find an attorney, I don't think I could very easily find one. Like, what questions would I ask to determine whether they're good or not? How would I know if they are good until after? And is it outcome-based thinking, or is it just, the chance of, having a bad outcome? Maybe it was the best approach that could have been taken, but the outcome just wasn't in my favor, right? That's just from the legal field, right? And you look at our field, it's the same way. Like, how do you choose an advisor in advance, not knowing in advance how they're going to do, right? Because nobody knows the future. So I think it's a challenge that faces a lot of professionals and people looking for that service. So while, certainly I feel like I do a good job, I acknowledge the fact that for prospective clients trying to find an advisor, it's really difficult. Like, there's lists of questions people can ask, but at the end of the day, how do you really know, right? Because there are advisors I know that when I started at the firm I started at, there were people lying to some of those questions. Like, they had just started a week before and they were saying, oh yeah, I've been doing this for like 10 years. I mean, the stuff that come out of people's mouth, and it was shocking. But, at the end of the day, it's really hard. I think I just have to acknowledge it's really hard for people to make that decision because, we're not talking about facts. We're talking about feelings, right?
Well, you're introducing what I think of as the trust factor. And that's why if you look at some of the statistics, I was surprised to see that the number of people that use financial advisors is much less than what I expected, much less than I anticipated. And it seems to be because they don't trust financial advisors, and maybe for some of the reasons that you're saying right now. But the way to start is what you said. The way to start in finding a financial advisor is to ask a series of questions. And you'd be surprised how many people like myself, when I first started to invest, never even thought about what kind of questions to ask. I just thought about, this person is recommended and I'm going to go with them. And that was not so smart. So there are lots of questions people can ask, like, for example, to the prospective financial advisor, do you invest your money in the things that you're advising me to invest in? What kind of stocks does your mother invest in? Do you have any disciplinary actions or complaints against you? Those are available on record. What is your investment philosophy? There's a whole bunch of questions like that, that people can ask. How long do your clients usually stay with you? What is the average account size of the investors you work with? These are some of the questions that people can readily ask. And sometimes people are timid about asking these questions, but they're consumers. The consumer has every right to ask all of these questions as part of informing yourself so that you can decide whether this person is a good person for you or not. So that's a great place to start.
Yeah, I think those questions are a decent place to start. I think there are a lot of questions that people ask that, I'm not sure it gets them in the direction that they want to go. Over the years, they typically are the same questions that people ask, and they're typically found from a blog post from some journalist who has no experience, but just said, oh, this sounds good, let's come up with these questions. But I just think about, what is, at the end of the day, what are you trying to accomplish with the questions, I think is the way you should be thinking about it. Not necessarily the answers to it, but how people answer it, and what kind of questions can help you discern the information you're trying to figure out. Because if you're just trying to check a box, right, and you're asking a question and you're saying, oh, well, this sheet says I should ask this question, you don't know why, then how are you supposed to contextualize the answer that they give you? Right?
Well, the way the person answers the question is also very informative.
Right.
How comfortable are they making you feel in the way they're answering? And is there an element, if you're asking a difficult question, is there an element of the potential advisor being defensive, or is he being very open about it? Is he able to share with you also his mistakes along the way? So all of this enters into the picture of the comfort zone and how comfortable you're feeling in talking with this person in advance of signing on with him.
Yeah, I think there's one thing that came up, certainly in my experience. A lot of people feel like they need to be with a big firm, and I think there's a lot of questions out there or perceptions out there that are, I don't want to say misguided, but maybe are not as important as people think they should be, right? Like people think, oh, well, it's a big firm, I'll be okay. What they don't realize is the big firm doesn't do anything for you. I mean, it doesn't do much, right? Maybe they give you research, but research is free. I don't need your research. I can get it for free. So the big firm had some gravitas maybe 40 years ago, but right now you're almost better off not being a big firm because, like you said, with your experience, the quote unquote boys downtown, you don't have to deal with that in a small firm. In a small firm, you have to do your own research. You have to find your own diligence. And you're not relying on the boys downtown, because the boys downtown, there was a great book called Full of Bull. I don't know if you read it. Phenomenal book. It's about one of the top leading institutional analysts back, I think it was in the late 90s, just kind of exposed in how the whole thing was BS. Like it was basically just a way for them to sell more investment banking. And it was totally biased research. If you listen to him, and here's a guy who's won awards every single year in his field. So I thought it was a fascinating book, but it's not surprising, right? Because Wall Street's about making money. It's not really about the end investor. It's about them making money. That's the point of their firms. So I think it's hard for investors to really see the full picture. The things they think are important aren't necessarily important sometimes, and they're not wrong for thinking it, right? It's like choosing between Apple or Joe and Susie Lunchbox's digital phone, right? You want an Apple phone, but sometimes it's hard to put those things into context.
I think your point is well taken, but it reminds me of research that was done after the debacle of 2008, 2009, during that terrible bear market in that period. And surveys were done about what happened between investors and their advisors. And it found that a substantial number of people that left their advisors during that period left their advisors because they did not have their phone calls returned in a timely manner. They weren't getting, they were scared, they were freaking out, they were scared, they're reaching out to their advisors, and the advisors, whether they're swamped or overwhelmed with other calls, were not responding sufficiently, properly to those investors, and those investors left those advisors. And I guess connecting that to what you're saying, if you're at a big firm and you have more clients, then it's going to be hard for you to get back to everyone at those times. But that's what happened. That people left their advisors because they weren't getting the service that they needed.
Well, let's talk about one other topic here before we get close to wrapping it up. Is, I know I've been around since the late 90s, so I've experienced a few of these bear markets and understand, the good and the bad parts of it and recognize them. One thing I noticed in 2008, 2009 was, this concept of, of not wanting to lock in the loss. You could look on the upside and say, seller's remorse, but on the downside, it was people not wanting to switch because they're just going to wait till it comes back. Right. I heard that all the time. Like, I talked to somebody in 2009 or 10 and they got referred to me and they're like, oh, I really need some help. And I talked to them and they're like, well, I might just wait till it comes back. I was like, what do you mean wait till it comes back? Like, what does that mean? You have a losing investment. You're going to wait till it comes back. Like, how about you just make a good decision today as opposed to looking at what you were thinking about, 5 years ago, right?
Because people don't want to have to feel the pain of the loss. So by keeping it as a paper loss, they're not experiencing the same level of pain as they would feel if they sold it. There's a term that I've called to describe what you're saying, which is called get-evenitis, which is a way of avoiding the shame of having to take a loss. And it's a way of mental bargaining, which says, if I have a loss and if I can wait till it comes back to my break-even point, maybe then I can sell it. So I wouldn't have to feel the shame of being exposed. Shame is about being exposed as lacking or failing in some way. And I wouldn't have to feel that shame. And so I play this mental bargaining game of what I call get-evenitis. And I think that's very prevalent and related to what you were just describing.
So you mentioned bargaining, which, if you talk about what is the 5 stages of grief, bargaining is what, third. So, can you talk about where that falls? Because I'm curious right now what your thoughts are based on where people are in the market, where we are in those 5 stages.
I think they're more at the part of the stage where they're feeling the pain and the despair, and they're trying to get to that. And these are not discrete phases, so there's some overlap between the phases. And I think the bargaining plays into it increasingly right now in the way that we're describing, because their losses are deepening and they don't want to have to feel the pain of taking that loss because they didn't cut their loss early. And so they're already feeling some of that pain, but they're keeping it as a paper loss and doing that mental bargaining of get-evenitis. So I think they're somewhere in that spectrum of the stages, which is including mental bargaining.
Okay, great. Well, Stan, I really appreciate you coming on the show and sharing your wisdom with us. I think as we kind of go through this bear market, the psychological aspects are paramount for people to both understand what they're going through and also help prepare themselves for future pain as it may be. So final thoughts you can provide us, and where can people find more about you and your new book?
Yeah, just a couple of quick thoughts are, very frequently what happens during a bear market is that there also is what we call, as you know this better than anyone probably, something called a relief rally. So where at some point in the course of the decline, there's a rise and people often get excited and become impulsive about rushing in to buy during the relief rally. So there's a cautionary tale about being aware of the relief rally and not necessarily jumping in. The second thing I think that's an important takeaway is to be aware of that history of the 10% gain over time, the average annual gain for the investor. And it's very seldom in any given year that the market gains between 9% and 11%. In other words, there's a rubber band effect in which the market overstretches in one direction or the other. So the investors need to be aware of that, because at some point there's also a reversion to the mean. It will overstretch in one direction or in the other direction, but will come back to the mean. So those would be a couple of my takeaways. Okay.
Well, I appreciate that, Stan. And where can people find more about you and your book?
Yeah, my book is called Smart Money, a Psychologist's Guide to Overcoming Self-Defeating Patterns in Stock Market Investing.
Great. Awesome.
Stanley H. Teitelbaum.
Great. Well, thanks for coming on, Stan. Really appreciate your wisdom. And yeah, we'll have you back on the future as things turn here.
Great talking to you, Kirk. Take care.
This is a public service announcement. Hi, my name is Kirk Chisholm, and I'm with the government, and I'm here to help. Doesn't that sound reassuring? Well, let's talk about how they're helping. The government needs your help to make our money worthless again. PPP loans, student loan forgiveness, helicopter money. Let's keep the party going until our money is totally worthless. Don't think it can happen? Sure it can. Just ask Zimbabwe, Venezuela, Greece, Germany, Hungary, Greece, Yugoslavia. Did I say Greece? As a loyal listener to the show, I want to give you free money. I'm giving away free money in one of these hyperinflationary currencies. Go to www.moneytreepodcast.com/free money and follow the instructions to get your free gift. I have a large audience and only a limited supply of these currencies. I'm not the Federal Reserve, so I will run out at some point. Make sure you get yours before I run out. Go to moneytreepodcast.com/free money. Follow the instructions and get your free money today. All right. Well, that was a great interview with Stan Teitelbaum. Glad we had him on the show. I think it's an important topic that we talk about, especially with the markets in upheaval as they are. I think it's really important to kind of go through and people understand how they're reacting, even though it may be subconscious, because I think a lot of our problems come from our mental challenges, not our intellectual challenges. So now we're getting into the panel portion of the show. So this week we have our very own Megan Gorman. Hey, Megan.
Hey, Kirk. How you doing today?
Doing great. Doing great. And we also have our very own Barb Friedberg. Hey, Barb.
Hi, happy to be here.
Great. Great to have you both. So, Megan, let's start with you. So what were some of your takeaways from the interview?
You know, first of all, I thought it was a really interesting interview because being in a client-facing position, you deal with client psychology all the time. And one of the things I actually want to give you, Kirk, for the show notes is I have a chart that's, I believe from BlackRock. And it's an amazing chart that sort of shows you the roller coaster that you can go through as an investor. And he mentioned it in the interview. And when you hear it, you're like, oh, okay, I think I get it. But when you watch the chart and you think about the markets and, you know, what you really understand that people do act poorly in managing their portfolio. And so I feel as someone who is client facing, part of my role is to spend the times during the good markets understanding people's behavior and understanding what they want to do in a perfect situation when things go south. And that my role in this time period that we're going through today as we tape this show is to remind them of what they said they want to do and push them psychologically to do it. And so a lot of the work, and I'm sure, Kirk, you do this as well with clients, a lot of the work I do with clients, particularly like after the 2008 and 9 crisis, after the 2020 crisis, was to talk about woulda, coulda, shoulda, right? What would you do if you were back in that situation again? And then remind them. And what I like to do is note this down. And so I talk about this a lot on the show, the investment policy statement, or IPS as the acronym is in the industry. But I feel that the mandate for the portfolio should talk about how clients feel or how investors feel when the markets come down and how they want to behave, because you want to drive behavior. So I know a lot of do-it-yourselfers listen to the show. I think one of the biggest values that having an advisor is that in the challenging markets, they can push you psychologically to behave in the right manner, or the manner that they wish to behave in a down market.
Yeah, I think that's a great point, Megan. We call that scenario-based thinking, which is looking through different scenarios and thinking how they feel. And I think it's, in some ways we're kind of, I don't want to say therapists, but, coaches, right? We're coaching people through psychologically things that they couldn't do themselves. I mean, there's a reason people have therapists. If you could do your own self-therapy, you wouldn't need them, right?
Right. And Kirk, so when you went through the 2020 crisis, right, and even today, like, what are you finding from your perspective with your practice with clients and sort of guiding them?
Yeah, I think it's actually an interesting question because, if you look back at the early 2000s, 2008, 2020, they're all very different periods. They have a lot of similar threads that run through the psychology that people have. But if you think back and how they played out, they were very different. Like the early 2000s were, oh, let's buy the dip for like 2 years in a row, right? And the NASDAQ was down 76% or something crazy. So, people were buying the dips all the way down. They thought, oh, I'm going to keep buying. Look how cheap it is. And, 2008 was crazy because people would just, literally, I was on my first anniversary in Nantucket. I was leaving, walking out the door, and AIG was going bankrupt. And I was working at Royal Alliance, which is a subsidiary of AIG. And I was like, oh my God, like this is going to be a terrible first anniversary. Fortunately, my wife's a saint. But the reality is like no one had any idea how bad it was going to be. And it was ugly for a lot of people. And I think that was more of a shell-shocked kind of situation where people just kind of went into their shell and they just stopped paying attention. Like, this is bad. I'm just going to ignore it. Hopefully it goes away. And then 2020, I think, was a bit of a surprise. I think people were fearful in other ways. I don't think that the financial markets were their top priority. They're worried, am I going to die? Which is, obviously a little bit higher in the priority list than am I going to run out of money? So I think that was different in that way, that people weren't prioritizing their money. They were prioritizing their health. Money was still important, but it wasn't, I could tell from talking to people, there was a secondary concern. And then of course we have this year, which, the markets are down 20 to 30%. And I think people are, I don't know, I'm not getting this feeling that people are freaking out. I think people are concerned, but I think they're still feeling like, oh, this will go away. Like it's just a speed bump and we'll get back on track. So I think there's some denial here going on with these markets. So I don't think it's set in. Like you think about the 5 stages of grief, right? There's denial, there's anger, there's, I always forget this other one. It's, there's the third one. The fourth one is depression and the fifth one's acceptance. I think the third one is something like negotiation or something along those lines. But, I think we're still in phase 1. We're still in the denial phase. People are like, oh, it'll go away. I think, so it hasn't hit people yet. So I don't think the full brunt of this, what we're going through this year is really set in for people. Barb, what about you? What are some of your initial takeaways from the interview?
I'm always fascinated by the psychology of investing because even though I have a master's degree in counseling, I'm married to a psychologist, I understand all of the psychological traps, I see myself having to fight against them. And so recognizing how your mind can really work against you during these periods is really important in overcoming that. And as Kirk and Megan said, a financial advisor can help you with this. If you don't have a financial advisor and you're a DIYer, it's really important to understand things like anchoring, which means you bought a certain stock at, say, 100. Now it's down to 80. And you have decided you're not going to sell until it gets back to 100. That's called anchoring on the $100 price. Well, that's absolutely ridiculous because what you want to look at is not getting back to a certain break-even point. You've already bought it. You want to look at it at 80. Would you buy it again? And if you wouldn't, then you sell it. So, and then it gets back to like sunk costs. This sunk costs is an economic term, which means money spent is gone. You're not going to get it back. Let it go, move on. So there's a lot of psychological things that you have to kind of confront yourself with so that you're not letting these fallacies hurt your future investment returns.
I want to touch on two of those with you, Barb, the anchoring, the sunk costs, because I think right now those are really important. So let's talk about anchoring. You know, the markets peaked in pretty much December of 2021 and have gone down between 20 and 30% this year. And I think a lot of people are looking at this as, oh, I'm down from the peak, right? As if that was somehow this like godly number that you have to exceed. And oh my God, I've lost money. But they're still up 10 to 15% above where it was pre-COVID. I mean, if you think about it, it's crazy to think that, yeah, you're down, but you're still way ahead of where you were, 2 years ago. So how does that play in?
You can imagine like, okay, let's just assume there was a 7% annual average rate of return from, say, 2015 to today. I haven't done the numbers, but I would assume we'd probably be at about the same point, or maybe even, less than our stock market returns today.
Yeah, I think it comes back to trying to time the top, right? Pick the top, pick the bottom, knowing that, oh, well, it was higher. So, as if that somehow magically you're going to be able to pick that. But you also mentioned sunk costs, which I think kind of is in a similar line. Can you kind of dig into that one a little bit more and what that means?
Sunk costs applies not only to investing, but so many other financial decisions we make. You pay for something, whatever it is. It's a stock, it's a bond, it's a car, it's whatever, that cost is gone. You're not going to get that cost back. So forget about it. Don't base your future decisions on what you've already paid for. Sometimes it's a good decision. Sometimes it's a bad decision. It doesn't matter. And it's the same way with an investment. You've already made that investment. So don't think about it. Don't stress over it. Be forward facing.
Good. No, I like that. I think that's hard for a lot of people.
It's really, really hard. I mean, all of this stuff is really hard. I mean, even like the mental accounting, which is another investor bias, is so big. Like we have pools of money, and this is really popular in the retirement planning arena. And I'd like to hear both Kirk and Megan's advice on this, because one of the biggest issues of the mental accounting is that money is different in different accounts. So, for example, retirees are recommended spend your dividends, preserve your capital. What difference does it make? It's all money. So they're not two different types of money. They're both money. If you have a capital growth of 12% in a stock, or you have a dividend payment of 5%, why not just sell some of the stock and spend that versus take the dividends and spend it? Is it different?
Megan, what are your thoughts? You want to comment first?
You go first. I'm trying to think of a good example.
Yeah, I think, this comes up a lot for us, the fungibility of money, where people think, oh, I got this money, or let's just say I inherited this money, right? I inherited $100,000, and let's say you're worth 500,000. You inherited 100,000, and people want to think about that 100,000 means something special because they inherited it, right? There's this attachment to this as if it's somehow separate from everything else. And it's fungible. Like $1 is $1, whether it's yours or Megan's or Barb's or whoever it is. $1 is $1. Either you have it or you don't. And you can either put it all in one bucket or you can put it into separate accounts, but it's still the same, right? Like at the end of the day, your net worth is your net worth. And what you do, like, I'll give you an example. Like, some people save money for retirement, and then they save money for their kids' college. And I mean, it's all the same, right? It's going into one big bucket. You just happen to partition it into different ways so that helps for your mental accounting of what you've saved for that goal. But, if there was an emergency and you didn't have any money and there's money there that you could take, I'm not suggesting you do this. It's hard to, because psychologically it creates problems, but you can certainly dip into the funds if you absolutely needed to, right? If you needed to pay for a new car, or because yours just broke and you didn't have any money saved, which I would advise you always start saving money for future costs that you don't expect. But I think at the end of the day, I think a lot of people in their mind, they look at things and they attach emotional value to things like cash, like an inheritance, not a stock, like just cash, right? If it's a stock, that actually comes into play too. Oh, I got this stock from my parents. I don't want to sell it, because they've attached emotional meaning to that stock, even though it may be a bad stock, right? It has nothing to do with the stock. It has to do with the meaning that they've attached to it, because of where it came from. And they want to perpetuate their parents' goal of what they were doing with that stock. And we see that a lot too. And I know sometimes it's a good stock and it's not a problem, but I think psychologically it's one of those things that when it happens, you realize, like, that's really not healthy for me to do, right? Or maybe it's not a stock, maybe it's a tchotchke, right? Or something that, your parent had that you attached emotional value to, and it's just sitting in your house because you can't emotionally get rid of it. It's not a good or a bad thing. It's just, you have to acknowledge that exists and that's happening. Because if you don't understand that you're doing that, you're going to end up with a lot of stuff that you don't need, that's carrying around this mental baggage.
Yeah, I have a little quick example that I run into a lot with mental accounting. A lot of times when I start working with people, they want to be in refunds, right? And I run into this a lot where they've built their cash flow around refunds, they've planned stuff around it. But, in proper tax philosophy, when you're in a refund, you've actually paid the government too much and you've made them an interest-free loan. And so that's one of those places where I think people need to be challenged. So I think in working with an advisor, some of these mental accounting things, it's often about challenging how you think about things and to see it and plan to work around it. So for a lot of times when I can move people out of refunds to increase monthly cash flow, I do so, because it's much better to have the monthly cash flow feel flush and build up your savings account, where actually today in July of 2022, you can actually earn a little interest versus these huge refunds to the government. So that's one of those examples of mental accounting where I try to work people through so that they don't just keep sort of being in huge refunds. It's not always possible though.
Yeah, I think that's a great example. I think probably a lot of that, I would imagine, Megan, is just a lack of understanding of how that all works.
Oh, totally. Yeah, because people are like, oh my God, my last guy, he got me a refund. Your last guy didn't do anything for you. You've paid in too much. You need to work with your withholding. And, it's one of the challenges of the US tax system is it doesn't, unless you really force yourself to be proactive in it, you are sort of always on tenterhooks. Like, what am I going to owe? What am my refund going to get back? Like it's a big surprise in April. And that is not the best way to manage tax planning. I wish to some degree we did a little bit more like the Germans, where it sounds weird, but they're still filing 2020 returns right now. You get over a year to work through the data. And then there are other systems around the world where they send you the return and say, is this correct? Right? Versus us inputting. So very different ways to do it. So I think the US system also, I guess the US government and the state revenue departments all take advantage of the fact of mental accounting and people like their refunds. I know that's the case here in California.
Well, I think the IRS, I think you hit the nail on the head. I think the IRS definitely plays with certain types of psychology with the American consumer. I mean, I know in my state, my accountant went to a seminar 4 years ago, I think it was, with the head of the Mass DOR, and a few of the accountants put their hand up and they're like, excuse me, I think you guys have some errors in your system. We're getting a lot of notices for things that aren't accurate. And his response was, oh yeah, we're aware of those, but we're not going to fix them because it's giving us way too much revenue.
Yeah.
Meaning that people are paying a money that they don't owe because they're afraid of the mass TOR. And mass TOR is like, okay, we'll take your money, even though they don't owe it. It's just, to me, it's just shenanigans that shouldn't happen. But
but you're bringing up a great point, Kirk, and I know this is off topic, but most notices tend to be incorrect. Like
right.
I just answered a notice for a client on 2 issues. There was a huge issue, which then we got back from the IRS that they were in agreement with us. And then they still put the small issue forward because it was a $2,000 tax bill. Yeah. And my client was like, should I just pay it? I'm like, oh, no, they're wrong. So we're going to get that money. But you bring up a great point. These systems are made to not benefit the taxpayer. So one of the things I want to get back to the psychology of this. One of the things that really came to my mind in listening to the interview, and I know, Kirk, we talked about this before the show, is such the difference with, men and women as investors. And I want to talk a little about women because I don't know how, I wish I had $1 for every time this happens, but I'll often go to work with a couple or I'll meet a group of women and they'll just tell me that they don't know anything about money and that they're really embarrassed about it. And so, it's almost like this sense of shame. And, I think that's one of these psychological things that, really it's important for women to power through. So, you cannot abstain on your investing, right? You cannot abstain on your money. And I think, one of the things is women don't feel comfortable that they should engage with it as actively as they should, right? They feel they need to be demure, keep it private, not really be as out front about it. And I think that that's some of the psychological behaviors that end up hurting women, because I find that once you get women into the markets, women are really good investors because when they study the behavior, women play for the long term. They don't react as abruptly to the marketplace. They tend to stick to strategy, right? And they tend to really understand their risk tolerance. And I think that last point is incredibly important because I have a group of male clients and I love them, but man, the minute the markets start coming down, they're like, should we change the asset allocation? And it's like, no, asset allocation is what gets you through the bad markets, right? Whereas the women do not question that. So there are some certain little quirks and psychological behaviors that I find women, speaking very generally, have. And it's stuff that I really, really encourage women to power through, to not abstain, and to embrace being in the markets. Like, jump in, the water's warm. Like it's really an empowering thing, and move away from that behavior of, I'm not really going to speak up in the meeting because I'm going to let my husband handle it because I don't really know much about money. And that's one of those behaviors I see all the time. And I'd be curious to hear your interpretations if you see that as well.
Yeah, I'd love to get into that. I have a question before I dive in on that. Is do you think for women it is more of a confidence issue or more of maybe like a social cultural issue?
I think it's both.
Yeah.
I think it's both. And here's one of the weird things. Like, I remember in my 20s, I was very into the markets, into money. And I think that it came across as abrasive. And now that I'm in my 40s, I do run into a lot of women who are like, I wish I could be like that. I think it's that culturally we're not forced into it unless we take this career path, right? And or you had a father that's influenced you. I do run into a lot of women that it's their fathers who push them into it because it's not seen as something ladylike. And so I do think it's a little bit of that. And then I think that there is this misconception that men truly understand the markets. I can tell you, I sit in meeting after meeting, and I have men say things to me which are completely incorrect about the markets, but they believe it and they say it with confidence. So when they say it with confidence, it sounds like it's the truth. So, a little bit of it is, and this is common behavior you see in all differences between the genders, right? In the workplace, in how we behave in society and so on. I see it in money as well. But once you get women in, they're good.
Yeah. Well, I'm going to speak for all men here. We definitely have all the answers, Megan. So I don't want to dispel that rumor.
No clue what he's invested in. So.
We know everything.
No, I think it's more men are given good confidence to be brave to go into the investment waters and to talk about it. And I think that should be commended. Women should take a lesson from that and just be brave to jump in and to know it's part of their responsibility to be financially engaged.
I think that comes down to like a cultural and societal kind of thing with men versus women, because I think men are taught to be confident, right? We have to be confident, because if we're seen as not confident, that's not seen as a good trait, right? By women or just by culture in general. And I think, so we have these cultural norms that we expect, and it doesn't bring out necessarily the best in us, because I mean, men, we have testosterone floating around, and I think it gives us more, let's just say more bravery a little bit. Like you said, we're braver and willing to take the risk more than I think men generally tend to be risk takers. I mean, I know just from raising boys, one of the things I learned from just reading and talking to a bunch of psychologists, like boys learn by taking risk. That's how they learn. That's how they adapt to the world, is taking risk. And if you don't let them take risks, they don't learn. Women learn differently, but that's how boys learn. So you have to give them that ability to take risks, so they learn the world, right? And they push boundaries. It's another thing I learned, is that you have to give them boundaries so they feel comfortable and confident, but they're always going to push those boundaries, because that's what they do. They want to push boundaries and see where the edge is and see where that line is. That's also how they grow. So I think the difference between men and women is really significant. And both, I think it's, I don't want to call it genetic, but I think it's certainly for the gender, it's appropriate. And I think it's societal and cultural as well. There's a lot of aspects there. But like you said, I think there's aspects to the male part that are really attractive when it comes to investing. And there's parts that are totally submarining their best efforts. I think women tend to be better investors for many reasons. I don't think they take the chances that they probably should to get good at it. I think your point of how women are perceived and maybe being a little abrasive. I mean, this is something I've said for a while. Like, I don't know when we'll ever have a women president, because in order to win the presidency, you'd have to be unattractive as a woman. Like the attributes you'd have to take on would probably make you unattractive as a candidate, because it's just the way that we see men and women are different. And not to say that a woman doesn't deserve to be president. I'm just saying, like, the way we would perceive that person to have those traits would be perceived maybe as unattractive as a candidate. So I think, I think probably the lesson to take away from here is both men and women have attributes that are good and bad. And I think we can learn from the other gender and try to take away some of those attributes and maybe implement them ourselves. So I think more women should be investors. I think they don't give themselves enough credit. I like working with my female clients because they're probably my best conversations. They listen, they pay attention, they learn. A lot of men they have something in their mind, they don't pay attention. They're like, this is the way I'm going to do it, and they don't change. Women are very adaptable and more willing to listen. So I have very pleasant conversations with women around investing, but I think, to your point, Megan, they don't have the confidence that they should in themselves. I think that's something that, and maybe that's a societal problem, but I think definitely with investing, it's something they can learn from.
Definitely. Barb, you've been quiet.
Yeah, Barb,
let's hear. Come on.
It's 2 to 1.
I have nothing to add, really. I think you guys have done a good job covering it, and I have nothing to add. I would like to change the subject a little, though.
Okay.
Go ahead.
Because we're in a situation now, like we all know, markets are down. But I'd like you to put on your hats of what if. And the what if hat is something that you can do in the future to help you cope better with the next downturn. And I think Megan and Kirk have both covered the idea of, if you have a financial advisor, you're going to be able to strategize with them. If you don't, you need to learn how to stress test your own portfolio. And I'm just going to give you a quick, brief tutorial in how to do that for the next time. So once you have your asset allocation of stocks versus bonds, you have to, and it might be a 60-40 stock versus bond, or if you're young, a 90-10, whatever. But then you have to plug in a scenario of what if. What if my allocation, my stock allocation drops 30% and my bond allocation drops 10%? And that's kind of on a worst case scenario. Obviously, it could get worse. You have to look at the result and say, can I stomach this? And if you do the math and you go, wow, if my overall portfolio drops 30% in the stock portion and 10% in the bond portion, and it will make my value down to this amount, and I can't handle this, then that's a note to you that you're into your asset allocation is too aggressive.
Yeah, I think that's good insight. And actually, it's funny you were talking about the 90-10, the 60-40. We had a good interview recently with Wes Gray where we talk about how you incorporate common sense into those kind of rules of thumb, which I'm excited to have that interview come out. So I want to touch on a few more, and then we can kind of wrap it up. Any other? Let me ask you, Barb. What other cognitive biases do investors have that maybe people can kind of learn from?
Herd mentality, FOMO. Oh my gosh. During the last 10 years, being in the heart of the investment world, looking at the public, globbing on to these investment apps, going all in, trading stocks, thinking you can't lose, because literally during the past bull market, it was like up, 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 up. Well, following the herd and not educating yourself, doing your own research is going to lead to a lot of troubles. I read online recently about a 20-year-old who had just started investing in the fall, and she's freaking out because if you started investing in the fall, then all you know are losses. And before you invest your first dollar in the investment markets, you have to understand investing is not doing what the gurus tell you. Investing is not following what everybody else is doing. Number one, it's understanding that your goal is to enable your dollars deployed into the financial markets today have a goal of growing for your future. But understanding that the price you pay for those expected higher returns, average higher returns over 100 years of stocks is in the 9% rate, 9% annualized range. Bonds is in the 5% annualized range. Understanding that during those averages, you will experience downturns like now. If you can't handle that, you shouldn't be in the stock market. If you are going to invest like other people without knowing what you're doing, you will be scared and disappointed. So give yourself, a couple of hours every week or two to learn about the basic principles of investing before you deploy your money.
Yeah, I think that's great advice, Barb, and I think a lot of people are kind of experiencing that now, certainly with the markets. And I think it's healthy instead of looking at what the average is. And this is actually a kind of a math thing that it applies to many aspects in life. When people say, "Oh, what's the average rate of return?" Right, 9% or whatever it is. What they really should be asking is, "What's the range?" Right? The average is great, but it'll never hit that. If the average is 9%, it will almost never hit 9% in a given year. It'll hit every other number, but it won't hit 9. And people should be asking, what's the range, right? What's the high? What's the low? What are the expectations of the range? And this is not just investing. This is everything, right? What's the probability of success? What's the range? So I think that's a helpful lens to bring into it. So I appreciate you mentioned that, Barb. So Megan, I wanted to kind of, as we get close to wrapping it up, I wanted to kind of start with you. Stan talked about choosing an advisor, and obviously that he had some bad experiences. It sounds like he made some very common mistakes, which is, helpful for all of us to learn. But, I don't know if you had any thoughts on that topic and how people should be looking at that, because that's a big question people should be asking themselves right now is, can I use advice?
Yeah, I mean, look, I think there's a balance in how you choose an advisor. On one hand, you've got to be doing your due diligence, right? What is your fee structure? How do you meet with me? How do you report performance? What are the services you offer for that fee? All of the basic questions. And then on the other side of it, there's the chemistry game. And so that's why I always tell people to interview 2 to 3 different people, because, excuse me, the advisor, when I'm giving advice to people, you give advice to people in good times and in bad times. And chemistry is incredibly important here. You don't want to work with someone that you don't really like that much, because you're not going to enjoy having the conversations with them. You're not going to be able to open up with them. You're not going to be able to give them the information that they need to guide you appropriately. And so it's not just the basic due diligence, but chemistry, and chemistry matters.
Yeah, I couldn't agree more. Barb, I know you have a lot of strong thoughts about this. So what are some of your thoughts around choosing an advisor?
I empathize with the individual who knows he or she needs an advisor and doesn't know where to turn. I thought the list of questions Megan rattled off were amazing. They were really, really good. And realize that this is a choice that you're going to have to devote some time to, because the options are mind-blowing. You can go with a robo-advisor like Personal Capital, Betterment, Schwab Intelligent Portfolios Premium, who have options to have certified financial planners as part of their package. But you also have to know what you're getting into. Do you get your own advisor? Are you able to choose what kind of services do they provide, and do they match up with yours? Or you can go with an advisor like Megan or Kirk, which are freestanding, and they charge you as a percentage of your assets managed. And they are fiduciaries. And so their decisions have to meet a standard that their recommendations have to be best for you, not best for them. But you have to interview them. You have to figure out, are they going to give you what you need? And then you can go with an advisor at a big firm, and they all have their managed plans. They range in fees, they range in services, whatever. It's so confusing. And so I would say give yourself 6 months to make this type of decision, and go through your options and have a list of questions and be systematic about, first of all, what are you looking for? And then interview a bunch of different options to find the best match for you.
Yeah, I think that's excellent advice. And I also empathize with investors looking for, choosing an advisor. I think it's really hard. And, the 3 of us, Megan, Barb, and myself, know a lot about the financial service industry, and other people don't. And even now, if I had to try to figure it out, I'd say, wow, I just thinking about all the choices, like Barb said, there are so many choices. And if I was picking one for myself, it probably might take me 6 months to find one, because there are so many choices and they're so very different.
Well, what I'm thinking about now is, I don't have any doubts about my investment plan, but I'm nearing retirement. I don't know if I'll ever retire or not, but I'm getting to that age. And it's like, I know I need some people to talk to about my tax planning, about I have a lawyer for my estate planning. I have a tax accountant, but I do think about, well, do I need a holistic person? Maybe I'm missing something. And it's paralyzing. It's frightening.
I think the hard part is I try to bring it down to a normal level. Like, I do this for a living. Megan and Barb do as well. I try to think about it as, what happens if I'm not here? Like, who would I recommend for my wife or my kids, right? Like, that's what I think about. And what process would I use for them? Because, I think the 3 of us understand how complex the markets are, and, how much they change. And to, to find the right choice for other people that you care about, knowing that you can't provide any insight is really hard, right? And I think so the common investor who doesn't have the insight into the inner workings of the financial system, like somebody who is in the system, I think I can't imagine how challenging it would be. So I love the insight that Megan and Barb brought here to how to look at this and how to make a choice. But I think it's a topic we'll probably talk more about here, because it's a very hard choice, and there's so many choices, and there are a lot of good choices, but they're different for each person. And I'll make one final comment and then we'll wrap it up. Is one thing I found funny, because this week I actually had a prospective client throw this in front of me. He said, "Oh, my advisor is recommending these 3 funds." And I'm looking at his portfolio, and he's got a hodgepodge of random garbage. It seems like the advisor he had literally just like pitched him funds that had no relation to other funds. It wasn't a portfolio. It was just a grouping of sales that the advisor made to this person. So it didn't have any, it didn't have any cohesion. It was like, oh, I've got, 3 large cap funds. I've got a high yield fund. It was whatever the flavor of the day is. And I think that's hard for investors to understand if they don't have that background, as they're relying on advisors to be experts, and some of them are just salespeople. So I think it's unfortunate, right? And Megan and I are fiduciaries, so we have a very high standard of care. But you have brokers out there that they get paid for selling a product, and their goal is to, I shouldn't say their goal, but they don't have the high standard that we have. So I think it's really important to understand what you're getting. And for some people, that might be a good fit. For some people, they just want ideas. They run their own portfolio. They use a broker. I had a guy like this. He used to use me for ideas. And if I gave him a good idea, he'd incorporate it. But he didn't want me to run his portfolio. He did that. He wanted ideas. But I think for most investors, what they're looking for is they're looking for wealth management. And that's kind of this more holistic approach. And I think if you're looking for that, then you really need to find an advisor that's a fit for that, not somebody who's just selling product. So as we wrap it up here, Barb, final thoughts from you?
Understand when you're looking for an advisor, one of the top questions, how are you compensated? You need to know that. Don't be afraid to ask that. I'm Barbara Friedberg. You can find me at Robo Advisor Pros, Barbara Friedberg Personal Finance, and on YouTube at Barbara Friedberg. See you next time.
Thanks for coming on, Barb. Megan, final thoughts from you?
Yeah, I said a lot on the show. So, I think it's just always good to help manage your behavior is to have someone to bounce an idea off of. So if you don't want to have someone managing your portfolio, there are great planners out there. There's great tax professionals who can all help you think through what your behavior is in terms of managing your portfolio. So I'm Megan Gorman. You can find me at Forbes.com/Megan Gorman. Kirk, thanks for having me on.
Thanks for coming on, Megan. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead. And remember, no one will care about your money like you do. So invest in your life.